Vietnam's strategic position, boasting a land border with China and a sprawling coastline spanning over 3,000 kilometers, confers a significant advantage in maritime logistics. Recent attention from Western media has been drawn to the redirection of orders to Vietnam amidst China's lockdown policies. Headlines like "Vietnam's exports surpass Shenzhen" and "Is Vietnam the next China?" have stirred discussions in China's media and online platforms, reflecting concerns about Vietnam potentially overshadowing China as the global manufacturing hub. A notable June report from the German newspaper Frankfurter Allgemeine Zeitung, titled "Goodbye China, Hello Vietnam," quoted a manufacturer remarking, "Vietnam appears to be a more appealing and cost-effective alternative to China. But can Vietnam truly step into China's shoes as a manufacturing giant? Our viewpoint suggests otherwise. We believe Vietnam, or any other nation for that matter, cannot replace China as the world's primary manufacturing center." In this video, we'll delve into why Vietnam falls short of becoming China's successor in manufacturing. Undoubtedly, Vietnam's economy is on the rise, spurred by relocations due to trade conflicts and geopolitical pressures. However, this growth doesn't signify Vietnam's readiness to assume China's mantle and single-handedly uphold globalization. Vietnam's manufacturing sector experiences rapid growth. Situated as a key player in Southeast Asia's frontier markets, Vietnam has emerged as a significant beneficiary amidst the ongoing trade tensions between the United States and China. The tit-for-tat imposition of higher tariffs between these economic giants has led to a noticeable decline in bilateral trade, prompting both nations to seek alternative sourcing destinations and manufacturing bases to navigate around these tariffs. In this context, Vietnam has become a favored destination for redirected trade flows and production chains. It presents businesses with an attractive alternative for manufacturing operations, aligning with the prevalent China Plus One strategy adopted by numerous companies seeking to mitigate escalating costs and geopolitical uncertainties in China. Recent investments from industry giants such as Intel, Samsung, and UAC underscore the country's immense potential in this realm. While it's clear that Vietnam cannot absorb the entirety of China's manufacturing capacity, it is well positioned to accommodate a significant portion of it alongside other regional players, thus playing a pivotal role in global value chains. Despite these positive developments, some analysts caution about emerging bottlenecks within Vietnam's infrastructure and regulatory frameworks, highlighting potential limitations on the extent to which the country can absorb additional manufacturing flows. Number 1. Human Capital Challenge. A significant hurdle in Vietnam's economic landscape is the scarcity of human capital. This concept encompasses the economic worth of a workforce, taking into account factors like educational attainment, skills, proficiency, and overall health. Vietnam boasts a youthful and expanding labor pool comprising individuals aged 15 and above who are either employed or actively seeking employment. However, compared to China, Vietnam's workforce is notably smaller in scale. To put it into perspective, Vietnam's population is just 1/14 in the size of China's, amplifying the risk of labor shortages significantly in direct comparison between the two nations. Viewed through an economic and demographic lens, Vietnam is unlikely to absorb a substantial portion of China's manufacturing output. According to figures from the World Bank, Vietnam's labor force represents a mere 7% of China's. This stark contrast implies that even if Vietnam successfully attracts manufacturing activities in key sectors like electronics and textiles, it cannot supplant China's overall production capacity. Number 2. Incomplete supply chains. Despite the upheavals caused by the trade tensions and the pandemic, China's robust and comprehensive supply chains, coupled with its formidable production capabilities, have proven resilient against global disruptions in recent years. This resilience has solidified China's position as a stalwart in global manufacturing, at least in the short term. While it's true that Vietnam has taken on the final assembly tasks for certain electronic products, China's overall manufacturing prowess has remained consistently formidable. Take Apple, for instance. Between 2019 and 2021, Apple reduced its manufacturing presence in mainland China from 48% to 42%, with much of the labor-intensive work shifting to Vietnam. However, during this period, Apple also onboarded 14 new Chinese suppliers, many of whom specialize in high-value and knowledge-intensive components such as optical components, sensors, and connectors. Despite Apple now having 25 supplier sites in Vietnam, this figure pales in comparison to the 151 in China and 41 in Taiwan. The primary reason for this disparity lies in the high concentration of component manufacturers in China. The relocation of manufacturing activities from China to countries like India, Vietnam, and Mexico has predominantly focused on the final assembly phase, akin to assembling Lego bricks. There has been minimal movement observed at the upstream end of the supply chain, where critical components like chips, magnets, and diodes are manufactured. The dynamics of trade between China and Vietnam also reflect a complementary relationship rather than direct competition. Vietnam's exports to China primarily comprise fruits, aquatic products, textiles, and electronics, while the country heavily relies on China for essential materials and equipment crucial to its labor-intensive manufacturing processes. Notably, China stands as Vietnam's largest intermediate supplier, accounting for nearly one-third of all intermediate product imports in the manufacturing sector. This deep integration with China has increased over time, leading to heightened dependence on Chinese inputs for production. While Vietnam has indeed experienced remarkable export growth, much of this growth is driven by foreign entities rather than domestic firms. Number 3. The influence of the domestic market. China possesses another critical advantage in the form of its expansive middle class and vast domestic market. According to previous McKinsey analyses, the Chinese middle class was projected to swell to 550 million by 2022, surpassing the entire population of the United States by more than 1.5 times. Companies eyeing the immense potential of the Chinese consumer base naturally gravitate towards establishing manufacturing facilities closer to their target audience, a strategy commonly referred to as nearshoring. For instance, in the aftermath of the trade war, Chinese products encountered steep tariffs upon entry into the US. Consequently, Chinese firms began shifting their manufacturing bases closer to their US customers, with Mexico emerging as a favored destination. Direct foreign direct investment from China into Mexico has witnessed a significant surge in recent years, with numerous Chinese enterprises establishing production facilities in Mexico to circumvent US tariffs. Consider the cases of Apple and Tesla, both global manufacturing behemoths that strategically selected China as their primary production hub. Their decision wasn't solely driven by the availability of cheap labor, but rather by the immense market potential in China. Greater China, encompassing mainland China, Hong Kong, and Taiwan, ranks as Apple's third-largest revenue-generating region, contributing 19% of the tech giant's total sales during the 2023 fiscal year. Similarly, Tesla recognized China's pivotal role in the electric vehicle market, prompting the company to construct its inaugural gigafactory outside the US in Shanghai. China now stands as Tesla's largest market after the United States, accounting for 33% of global sales in 2023. The Shanghai Gigafactory operational since 2019 and serving as Tesla's primary export hub, delivered an impressive 947,000 vehicles in 2023, surpassing production figures from the US Gigafactory. In the near future, Vietnam will likely maintain its appeal for foreign investment and as a hub for diversifying supply chains. However, its capacity to significantly diminish China's dominance in manufacturing is constrained. This is why we believe that neither Vietnam nor other countries such as India and Mexico can swiftly replace China as a leading manufacturing center. Do you share our perspective from the video? If you found our insights valuable, please consider liking and supporting our content. Don't forget to subscribe to our channel for more engaging videos like this in the future.